This is Principles of Finance, Chapter 3. We're going to be looking at financial statements and financial ratios. Generally accepted accounting principles are the practice and procedure guidelines that are used to prepare and maintain financial records and reports. These are authorized by the Financial Accounting Standards Board. Sarbanes-Oxley of 2002, which is often called SOX, was passed to eliminate the disclosure and conflict of interest problems of corporations. The Public Company Accounting Oversight Board is charged with protecting the interests of investors and furthering the public interest in the preparation of informative, fair, and independent audit reports. Any company that has more than $5 million in assets and more than 500 shareholders are required to report to the SEC. They're required to provide shareholders with the annual stockholders report. This is the 10-K. Remember when we looked at Edgar and we searched for 10-Ks and proxy statements, the DEF 14As? We found all of this information. The International Financial Reporting Standards are established by the International Accounting Standards Board. 80 countries now require their firms to comply with the International Financial Reporting Standards. The United States, however, require financial results to be reporting using generally accepted accounting principles. These are much more stringent than the International Financial Reporting Standards. It's difficult to compare international and domestic financial statements simply because the United States public companies are required to follow more strict guidelines. Near the end of every quarter, most companies unveil their quarterly performance. If a firm beats their analyst estimate, they often see their share price jump, while those that don't quite make analyst estimates tend to suffer price declines. The most anticipated performance measure is earnings per share, and this is what's usually compared to the estimates of analysts. So the pitfalls of using reported earnings as a measure of performance. It's easy for managers to mislead investors, sometimes within the generally accepted accounting principles and sometimes not. The process of manipulating earnings to mislead investors is known as earnings management. For example, General Electric beat estimates every quarter for 10 years, from 1995 to 2004. In 2009, the SEC fined General Electric for $50 million for improper accounting practices. So Warren Buffett has some words of wisdom. First, he says, weak visible accounting practices are typically a sign of bigger problems. When you can't understand management, the reason is probably that management doesn't want you to understand them. Investors should be suspicious of projections because earnings and growth do not typically progress in an orderly fashion. Managers that always promise to make the numbers will at some point be tempted to make up the numbers. And you can see this if you were to read very many proxy statements. You would see which companies are being honest and open and those that are trying to conceal things. It's very easy for a company to throw in a lot of legal jargon and to put things in odd order, so it's difficult to find what you're looking for within these statements. And they generally do so because they're trying to. So we're going to cover the income statements, the four key financial statements, and we're going to start with the income statement. The income statement provides a financial summary of the company's operating results for a specific period. They are prepared quarterly for reporting purposes, so you can find these on the 10-Q on EDGAR. But for management, they're usually computed monthly. So again, those are available on the 10-Q statements on EDGAR. So the income statement, balance sheet, and cash flow statement are interrelated. The income statement is going to describe how assets and liabilities are used during the period. The balance sheet says, where does my business stand today? What do I owe? And what do I own? And the cash flow statement explains the inflows and outflows of cash. So one important way the financial statements are used together is in the calculating of free cash flow. We'll cover this more in depth in a minute, but a lot of free cash flow says that a company is able to pay their debts and their dividends. So first we're going to look at the income statement, which asks, how well did my business do during this period? So the income statement starts with revenue. This is any money paid to suppliers. This is any money that's brought in from the company. So in the sale of goods or services. From that, you deduct expenses. So any money that's paid to suppliers or employees. This includes things such as cost of goods sold or operating expenses. And from that, you subtract depreciation. So depreciation is not a real cash flow. At the end of the month, you're not going to have a check written to depreciation. But this gives you earnings before interest and taxes. From earnings before interest and taxes, you deduct any money that you pay on your debt, so the interest expense. And that leaves you with earnings before taxes. From earnings before taxes, you deduct any taxes. This is money that you owe to the government to give you net income. You deduct dividends paid to preferred shareholders. And that leaves you with the earnings that are available for the common shareholders. So at this point, there is one of two things that can happen with this earnings available to common shareholders. On one side, it could actually be paid to the shareholders. On the other side, it could be reinvested. So here's a good time to show you exactly what we mean by this whole double taxation. So here, corporations earn money and they pay taxes on this money at the corporate tax rate. They then take that money And if they choose to pay it to shareholders, shareholders are then taxed at the personal income tax rate. So these people up here at the top, they have relatively little risk. So these are cash flows that have a little risk. So it's money that's going to be paid to your employees, to your debt holders, to the government. Down here at the bottom, for common shareholders, this is high risk, but unlimited return. So common shareholders are not promised anything, but they also face losing everything that they've invested within the company. At the same time, however, they have unlimited rewards. From the income statement, you can calculate earnings per share. Earnings per share represents the number of dollars earned during the period on behalf of each share of common stock, and is calculated as earnings available to common shareholders over the number of shares of common stock. Dividends per share, very similar. It's the dollar amount of cash distributed during the period to each share of common stock. And to calculate dividends per share, it's dividends paid to common shareholders divided by the number of shares of common stock. So here's an example of an income statement, which is posted on Canvas, so you can print this out via your PowerPoint slides. But earnings per share is equal to the earnings available to common shareholders, right here at the bottom of the page. It's back on black ink. So that's equal to 221,000. And we divide that by the number of shares of common stock outstanding. And we see in 2012 that that was 76,262. To give you earnings per share of $2.90. We could also calculate dividends per share. Dividends paid to common shareholders over the number of shares of common stock. So the second financial statement that we're going to look at is the balance sheet. And this presents a summary of the firm's financial position at a given point in time. The statement balances what a firm owns with what it owes and what was provided by the owners. And it answers the question, where does my business stand today? So this is what a balance sheet looks like. We have assets on the left-hand side and liabilities plus equity on the right-hand side. So on the asset side, we start with the most liquid assets and work down to the least liquid. So at the very top is cash. So to that we would add accounts receivable, and inventory. These make up current assets. Current assets are then added to fixed assets to give you total assets. So current assets are those assets that are expected to be converted to cash within 1 year, whereas fixed assets are long-term, such things as your equipment or your building. So this goes from more liquid. So can be converted to cash quicker. 2, less liquid. On the liabilities and equity side, things are listed from short term to long term. So the most short-term liabilities that we have are accounts payable. These are things that we've bought on credit and intend to repay in the near future. To that we can add notes payable, and that gives us current liabilities. Current liabilities are short-term, and they expect to be paid within 1 year. If we add to that our long-term debt, that gives us total liabilities. And once we add in shareholders' equity, we have total liabilities plus equity. These sides must equal one another. So they must be equal to one another. Assets have to equal liabilities plus equity. So here's a picture of a balance sheet. So on the asset side, that's what we're looking at. Cash, obviously everyone knows what that is, but marketable securities are very liquid, short-term investments. These are usually things like T-bills or CDs. Accounts receivable is money owed to the firm by customers on credit sales. Inventories include raw materials, work in process, and finished goods. Fixed assets is the original cost of all fixed assets owned by the firm, so property, plant, and equipment. And depreciation is the total expense recorded for the depreciation of these fixed assets. On the liability and equity side, we start with accounts payable. That's money owed for credit purchases by the firm. Notes payable, these are outstanding short-term loans, usually from commercial banks. Accruals are amounts owed for services for which a bill has not yet been received. So it's money owed but not paid, so such things as salaries. Long-term debt is debt for which payment is not due in the year. Shareholders' equity is the owner's claim on the firm. Preferred stock is the historical proceeds from the sale of preferred stock. Common stock, the main thing of importance here is that common stock has a par value, and you use that to determine the number of shares outstanding. All common stock has a par value. These are usually set very low at $1 or less, because some states have rules that say that your stock cannot trade for less than its par value. So if your stock price were to fall and it was below your par value, that would be illegal. Paid in capital in excess of par in common stock is the proceeds received from the original sale of the common stock in excess of the par value. Retained earnings is the cumulative total return of all earnings that have been retained and reinvested in the firm since inception. So the third statement we're going to look at is the statement of retained earnings. It reconciles net income earned with cash dividends paid with changes in retained earnings. So this company began the year with $1,012 in retained earnings. Profits were $231. Dividends paid were $108. So year-end retained earnings are $1,135. So the net increase for this company is $123. So the net increase in retained earnings is equal to the 1,135 minus the 1,012 to give you 123. The final statement we're going to look at is the statement of cash flows. It's the summary of cash flows over a period of concern. So it reconciles these cash flows with changes in cash and marketable securities. And this statement ties the income statement and previous and current balance sheets. So this statement of cash flows is going to ask, where did our cash come from and how did we use it? So we have our sources of cash flow. And our uses of cash flow. These fall under three separate activities. Our first is profitable operations. So the main way that we receive cash flow is to have a profitable business. The opposite of that is unprofitable business. The second is the sale of long-term assets. The opposite, a use of cash flow, would be the purchase of long-term assets. Another way that a firm can receive money is an equity infusion. So the owner invests money. The opposite of that is a withdrawal by the owner. Another source of cash flow is long-term borrowing. And the opposite of that is the repayment of debt. So these four sources and uses of cash flow fall into three unique activities. So profitable and unprofitable operations are considered operating activities. The purchase and sale of long-term assets are considered investing activities. And finally, numbers 3 and 4, equity infusions and withdrawals, long-term borrowing and repayment, are considered financing activities. So operating activities, cash flows from those, are cash flows that arise from normal operations. Cash flows from investing activities. These are cash flows that arise from activities such as the acquisition or disposition of current and fixed assets. and cash flows from financing activities. These arise from raising or decreasing cash through the issuance or retraction of additional shares or through short-term or long-term debt for companies' operations. And here is a visual of a cash flow statement. So each of these actions are broken down according to their activities. Ratio analysis involves methods of calculating and interpreting financial ratios to analyze and monitor the firm's performance. So why should we look at financial ratios? It helps us determine if companies are creditworthy. Only a small portion of overall business analysis. We also have to look at the industry characteristics, agency issues, strategy of the company. There are multiple types of ratios that we're going to look at. But first we're going to look at the two ways that you can compare either an industry to itself or to others. So a cross-sectional analysis is the comparison of different firms' financial ratios at the same point in time. So you're comparing one company to its competitors at the same point in time. The important thing to do is to identify your industry correctly. So if you remember back when we talked about Mergent, I showed you how to add competitors to your industry analysis. So that way you could define your industry exactly how you chose. A specific type of cross-sectional analysis is benchmarking. This is where the firm's ratio values are compared to those of a key competitor. Benchmarking allows you to compare yourself to someone that you want to emulate. It's also popular to compare yourself to industry averages. So here we are looking at some different ratios for various industries. And you see that you need to make sure that you compare your industry to similar stores. So, yes, Walmart is a grocery store, but they're also a merchandise store. So identifying whether or not you want to compare them to Kroger or to Big Lots or to Sears. These are decisions that you have to make independently, but each have different ramifications. But this is an example of cross-sectional analysis. So we're comparing one company to its key competitor, such as Lowe's to Home Depot. That would be a type of benchmarking, a type of cross-sectional analysis where Lowe's is comparing itself to its key competitor. But this is cross-sectional analysis in general too. So, for example, Dell is being compared to the computer industry. That is cross-sectional analysis. Time series analysis is evaluating a firm's financial performance over time. So we compare current to past performance using ratios, and this allows us to assess a firm's progress. We can see developing trends when we use multi-year comparisons, but the most informative approach is to use both cross-sectional and time series analysis together. So if we were to look at the yellow line alone, so ignore the blue line, that would be an example of a time series analysis. So we're seeing how Bartlett Company's average collection period has changed over recent years. When we include the industry averages as well, that's a combined analysis. So not only are we comparing Bartlett Company to itself across time, we're comparing Bartlett Company to the industry and itself across time. There are some cautions when using financial ratios, and there's some major limitations. Ratios reveal the possibility of a problem. They don't necessarily mean that there is a problem. It means there might be a problem. A single ratio does not provide sufficient information to judge overall performance. When calculating ratios, you should use financial statements dated at the same point in time. It's preferred to use audited financial statements. The financial data being compared should be developed in the same way, and results can be distorted by inflation. There are some limitations with financial ratios. Different firms use different accounting procedures, so there may be some window dressing issues. Seasonal and non-current items and events may distort financial performance, and there is no underlying theory that helps us establish benchmarks. It's also difficult to evaluate conglomerates from the consolidated financial statements. Additionally, generally accepted accounting principles are not applicable to all international companies. The first type of ratio that we're going to look at is a liquidity ratio. Liquidity ratios ask if the company can meet its short-term obligation using the resources that it currently has on hand. So the first liquidity ratio that we'll use is the current ratio, and that's defined as current assets over current liabilities. To calculate these ratios, we are using the Chapter 3 handout available on Canvas. It's Bartlett Company Income Statements and Balance Sheets. So the current ratio determines how well a company can pay its short-term liabilities with its short-term assets. The theory is that the more liquid assets a company has, the more ability they have to pay their short-term obligations. So looking at the Bartlett Company income statements and balance sheets, we can calculate the current ratio. So the current ratio is equal to current assets for 2012, 1,223. These are reported in thousands, divided by current liabilities of 620,000. I found these numbers on the balance sheet, current assets, and current liabilities. And this gives us a current ratio of 1.97. So is this good or bad? A current ratio that is greater than 1 is generally considered good. If the current ratio were less than 1, then the company may have problems in the future. This may not always be the case. If a company is too conservative, they will hold too much of their assets in cash instead of investing them, which would cause their current ratio to be very high. Or if they're too aggressive, then they may be unable to borrow from banks, and they may not have any way to borrow money. In theory, all current assets can easily be converted to cash, but this is not always the case. The value of inventory reported on the balance sheet may not be an accurate representation of what it's actually worth. So suppose that you're a manufacturer of Thai Beanie Babies. I don't know for certain, but I imagine there's not a huge demand for Thai Beanie Babies anymore. So if you have 10,000 Thai Beanie Babies in your warehouse, you may have them reported as being worth X amount of dollars, when in reality, you can't sell them for that much money. Large companies usually have well-established relationships with banks that can provide lines of credit and other short-term loan products. This makes them not need to have large stores of cash on their balance sheet. For example, if you look at our ratios that we just viewed right here on slide 6, you see that Lowe's and Home Depot have a current ratio that is half the industry average. Large companies generally have these well-established relationships with banks that they can access if they are facing liquidity problems, so they don't need to have large stores of cash. So, although inventory is seen as a current asset, we just discussed how it may not be, the value of the inventory may not be representative of its true market value. So if your company is doing poorly, the inventory that you hold may not be worth what you think it is. So a more conservative measure of liquidity is the quick ratio. The quick ratio is equal to the current assets minus inventory divided by current liabilities. We can do this for Bartlett Company. So we know our current assets found on the balance sheet is 1,223. If we subtract off inventory, that's 289. And we divide by current liabilities of 620. This gives us a quick ratio of 1.51. Again, this is measuring how easily we can pay our short-term obligations. And again, higher is better. A quick ratio greater than 1 is generally considered safe. Inventory is very important. If we compare Dell, Home Depot, and Lowe's, we see that all three have a current ratio of 1.3. If we look at the more conservative ratio, if we look at the more conservative measure of liquidity, the quick ratio, we see that their quick ratios are drastically different. This means that Dell is not holding a great amount of their goods in inventory, which is probably a good thing because Dell is in the technology industry, which is changing swiftly. So if they had a whole bunch of processors in their warehouse, by the time they were actually able to use them, they probably wouldn't be worth nearly as much as what they had written them down as. Home Depot and Lowe's are in a different category. When you look at Home Depot and Lowe's, they have humongous stores with tons of inventory, things such as lumber and siding, things that aren't going to lose a lot of value. So it makes sense that their quick ratio is significantly lower than their current ratio because they are holding large amounts of inventory. Asset management ratios measure how efficiently a firm uses its assets and how much the firm has tied up in assets for every dollar of sales. We're going to look at inventory turnover, which is cost of goods sold divided by inventory, which measures, again, how efficiently the firm operates. So if we apply this to Bartlett Company, we see cost of goods sold is found on the income statement. That is $2,088. And we divide that by our inventory levels, which is found on the balance sheet, 289. And we see 7.2. So the inventory is turning over 7.2 times per year. We can also calculate the average age of the inventory, which is 365 divided by inventory turnover. Applying this to Bartlett Company, we see 365 divided by 7.2, and we get 50.7 days. So the average piece of inventory for Bartlett Company is sitting on the shelf for 50.7 days. Again, these ratios are going to vary drastically by industry. Just imagine a car lot. If Bartlett Company were a car lot and the car were sitting in the car lot for 50.7 days, that may not be so bad. But if Bartlett Company were a grocery store and this was a head of lettuce that we were talking about, that would be horrendous. Another measure that we can use is the average collection period. This is also known as, aka, days sales outstanding. And is equal to accounts receivable over average sales per day. We can calculate this for Bartlett Company. We see that accounts receivable is 503, found on the balance sheet. And we divide that by annual sales found on the income statement, 3,074 over 365. If you work this out, you'll have 503,000 over 8,422, and that's equal to 59.7 days. Again, this number is going to vary by industry. Grocery stores usually sell to people using cash and credit cards, while auto dealers finance cars and negotiate agreements with vendors who agree to pay for the car after the sale has been made. Companies in the building, materials, grocery, and merchandise stores usually collect in just a few days, while firms in the computer industry take roughly 2 months to collect on their sales. The difference is primarily due to the fact that these industries serve very different customers. So the average collection period needs to be examined by the industry. Average payment period, that's equal to accounts payable over annual purchases. Annual purchases are not something that you'll find on the income statement or balance sheet, so you have to make assumptions. So we'll suppose that purchases are 70% of its cost of goods sold. So then we would say that purchases would be equal to 70% of our cost of goods sold is found on the income statement, and that is equal to $1,461.6 thousand. So we can calculate this for Bartlett Company. Accounts payable is $382,000. And we divide that by accounts payable is found on the liability and equity side of the balance sheet. We divide that by our purchases over 365. And that gives you 95.4 days. So again, this is how long it takes to pay their bills. Total asset turnover. How quickly are our assets turning over? Sales over total assets. For Bartlett Company, we have sales in 2012. $3,074. We divide that by our total assets found on the balance sheet, $3,597. And that gives us 0.85. The grocery business turns assets over faster than any of the other industries, and that makes sense because their inventory is among the most spoilable, for lack of a better word. They have to sell their baked goods and their dairy products and their produce quickly, or they're going to have to throw them away once they do spoil. On average, a grocery store has to replace its entire inventory in just a few days or weeks, and that contributes to the rapid turnover of the firm's total assets. Again, if you're comparing 0.85 to a car lot, that may not be a bad number at all. You just need to make sure that you've defined your industry correctly. So days sales outstanding, that's the same as the average collection period, which we already did. Fixed asset turnover. This ratio measures our ability to generate sales from fixed assets. It's most often used in the manufacturing industries. When companies make large purchases, investors watch this ratio to see how effective the investment was. To calculate the fixed asset turnover, that's sales over net fixed assets. For Bartlett Company, our sales are $3,074. We divide that by net fixed assets. Net fixed assets are on the balance sheet, the asset side, $2,374. And that's 1.29. Again, each of these ratios need to be compared to industry averages or against the firm itself over time. So you need to either do a cross-sectional or a time series analysis to make sense of any of these ratios. Debt management ratios. Does the company have too much debt? Can the company's earnings meet its debt servicing requirements? So the first debt ratio that we're going to look at is the debt ratio, and that's total liabilities over total assets. The debt ratio takes into account all debts to all creditors. And for Bartlett Company, our total liabilities is found on the liability and equity side of the balance sheet, and total liabilities is $1,643. We divide that by our total assets, $3,597, also found on the balance sheet, to give us 0.457. So 45.7%. That means that 45.7% of our assets are financed. The times interest earned ratio is equal to earnings before interest and taxes divided by interest. If you'll notice on our income statements, operating profits and earnings before interest and taxes are the same thing. I went ahead and wrote that on the income statement for you. So if we calculate this for Bartlett Company, we see our earnings before interest and taxes is $418. We divide that by our interest expense, $93, and that gives us 4.5. So for Bartlett Company, this means that Bartlett Company makes enough to cover its interest expense for 4.5 times. So a higher times interest earned ratio is better. It means that a company can afford to pay its interest payments. Profitability ratios measure a company's rate of return on sales or assets or just about anything. First, we'll look at gross profit margin, which is sales minus cost of goods sold over sales. For Bartlett Company, sales is $3,074. Subtract our cost of goods sold found on the income statement and divide that by sales. And you get 32.1%. So when we deduct only cost of goods sold, this company is keeping 32.1 cents of every dollar sold. This is the least restrictive definition of profitability that we use. The next that we're going to look at is the operating profit margin, which is operating profits, so earnings before interest and taxes, over sales. So for Bartlett Company, our earnings before interest and taxes, or our operating profits, is found on the income statement, $418. And we divide that by sales of $3,074. And that's 13.6%. So once we've accounted for our cost of goods sold, our selling expenses, our administrative expenses, depreciation, our lease expenses, and our operating expenses, once we've covered a lot of our expenses, we're still keeping 13.6 cents of every dollar sold. The most restrictive definition of profitability that we're going to look at is the net profit margin, and that's equal to earnings available for common shareholders over sales. Earnings available for common shareholders is found on the income statement, $221. Divide that by sales, and we get 7.2%. So once we've accounted for all expenses, we are keeping 7.2 cents of every dollar sold. A common profitability ratio is earnings per share. This is equal to earnings available for common shareholders over the number of shares of common stock outstanding. For Bartlett Company, earnings available for common shareholders is 221. Again, remember those are thousands. We divide that by the number of shares of common stock outstanding. And if you see footnote B of the income statement, it says that common stock outstanding was 76,262 in 2012. So that gives us earnings per share of $2.90. If we want to look at return on assets, that's earnings available for common shareholders over total assets. Earnings available for common shareholders is $221,000 over total assets on the balance sheet, $3,597, and again these are in thousands. So that's 6.1%. So for Bartlett Company, this return on assets means that every dollar of assets earns 6.1 cents. So it measures how well a company converts assets into profits. Again, higher is better. Return on equity, how well is the company using owners' money, is equal to earnings available for common shareholders over common stock equity. So earnings available for common shareholders, that's found on the income statement, 221. And we divide that by common stockholders' equity. And that's calculated as total shareholders' equity minus the preferred stock, so 200. That's 221,000 over 1,754. And that's 12.6%. Basic earning power is equal to earnings before interest and taxes over total assets. Higher is better. A higher basic earning power means that the firm is more effective at generating income from assets. It allows comparison across companies with different taxes and leverage because it looks at earnings before taxes and interest. So here, for our company, we have earnings before interest and taxes of $418,000. and total assets of $3,597,000. So that gives us basic earning power of 11.62%. So our basic earning power less our return on assets, 11.62 minus 6.1%, would be equal to 5.5%. So 5.5% of our revenue is expensed out as interest expense and taxes. Return on assets is lowered by debt because interest expense lowers net income, which also causes a lower return on assets. The use of debt lowers equity, and if equity is lowered more than net income, ROE would increase. Market value ratios will be covered next. So high levels of earnings and cash flow increase market value ratios. High expected growth in earnings and cash flow increase market value ratios. And high levels of risk decrease market value ratios. The first that we're going to look at is a price-earnings ratio. The price-earnings ratio is equal to the market price per share of the common stock over earnings per share. So first you would need to know the market price of common stock. So Bartlett Company is trading for $32.25 at year end 2012. So we can use this to calculate our price earnings ratio. Market price, $32.25 divided by earnings per share, found on the income statement at the bottom. We also just calculated that at $2.90. That's 11.1. A high price earnings ratio means that investors expect an increase in earnings growth. It tells you how much investors are willing to pay for every dollar of earnings. You can use the price earnings ratio to calculate the intrinsic value of your stock using the price earnings multiple. Market to book ratios. The market to book ratio is equal to the market price per share of common stock over the book value per share of common stock. The first step is to calculate the book value per share of common stock, which is equal to common stock equity over the number of shares of common stock outstanding. So if we get the book value, we have common stock equity. Remember, that's the 1,954 minus the 200 in preferred stock divided by number of shares of common stock outstanding. Footnote B of the income statement, 76,262. And that gives you $23 per share. So you can use that to determine your market to book ratio. So the market price we just said was $32.25. Divide that by the book value of 23. And you get a market to book ratio of 1.4. What does this mean? If the market to book ratio is greater than 1, the stock is undervalued. Please scratch that, I just said it backwards. If the market to book ratio is greater than 1, that means the market price is greater than the book value, the stock is overvalued. If the market to book ratio is less than 1, the market price is less than the book value, then it's undervalued. This is what we just did. So the price earning ratio tells us how much investors are willing to pay for every dollar of earnings. Higher is better. Market to book tells how much investors are willing to pay for every dollar of book value. Higher is better. The price earnings multiple and the market to book ratio are high. If the return on equity is high, risk is low. The DuPont system of analysis is used to dissect the firm's financial statements and to assess its financial condition. It merges the income statement and balance sheet into two summary measures of profitability. The modified DuPont formula relates the firm's return on assets to its return on equity using the financial leverage multiplier. The DuPont system first brings together net profit margin, which measures your firm's profitability on sales, with its total asset turnover, which measures how efficiently the firm is using its assets to generate sales, to calculate return on assets. So return on assets is net profit margin times total asset turnover. If we substitute into the formulas, because remember the formula for net profit margin is earnings available to common shareholders over sales, and total asset turnover is sales over total assets. So in this equation, dividing by and multiplying by sales cancels them out. So you're left with earnings available for common shareholders over total assets, which is your formula for return on assets. It just allows you to break return on assets into two different components. So for Bartlett Company, we had a net profit margin of 7.2% and total asset turnover of 0.85. So this gives us our return on assets of 6.1%. We can further show the effects of leverage when looking at return on equity. So the modified DuPont formula is taking the return on assets that we just calculated, multiplying it by the financial leverage multiplier, which is total assets divided by common stock equity, and translating that into return on equity. So return on equity is equal to our earnings available for common shareholders over total assets, and financial leverage multiplier is total assets divided by common stock equity. So again, total assets is going to cancel. So you're left with earnings available for common shareholders divided by common stock equity. So for Bartlett Company, we get a financial leverage multiplier of 2.06. Earnings available for common shareholders was 3,597, and common stock equity is 1,754. That gives you 2.06. So when you multiply that by the return on assets of 6.1%, that gives you return on equity of 12.6%. So it just allows you to see why your return on equity is where it is and what factors caused it to be that way. So you can break it down even further. You can get it down to some really nitty-gritty things that allows you to have a clear eye on where your problems are coming from and why your numbers are perhaps not measuring up to your competitors. So like for example, if you go back to table 3.5 and we look at Dell versus Home Depot, the ROA for Dell was 4.3% and Home Depot's is 6.5%. And you can see why in the DuPont formula. And it boils down to the net profit margin. Home Depot's net profit margin is 4%, whereas Dell's is 2.7%.